The end of every month is a caution day, but frankly, it starts 8 to 3 days out. And the reason for that is redemptions. So I'm not saying that the end of every month is going to be a sell-off, but I can't be surprised by some of the weakness that we're seeing right now. I don't want anybody thinking that the market is just going to unceremoniously sell off as we wrap up a month, but do expect that we might see some weakness, most especially within the last 3 days of the last trading day of the month. Now, where does this come from? There's a neat article from Wall Street Journal called The Dark Magic of Month-End Trades. And just Google that title and it should come up. And give this article a read. In fact, there's a white paper that this article is based on. And it's three Finnish researchers that did this white paper called Dash for Cash. And it basically outlines why stocks tend to get weak near the end of the month and why they tend to be strong in the beginning of the next month. And it has to do with redemptions. And I'm going to, here's the punchline. It has to do with redemptions and then reinvestment. So they've really just gotten stronger over time, because if you look at the sample of the Dash for Cash white paper, it's basically the uber bull market that we've seen since the financial crisis recovery, what we've done since 2008. And what we've seen, and here's the kind of basics of the whole idea right in here. The idea is that you buy shares 3 days before the end of the month and sell them 3 days into the new month. In other words, you buy into weakness, you sell into strength. I'm not telling you this is a setup, but there's a rhythm here. There's a rhythm here. And the reason for that is the very next paragraph. Funds are selling holdings into the dip and buying them during the rise. And that's really what's happening. The 401k effect is what? People are going to get redemptions at the end of the month. We like to pay ourselves. That's where a lot of that weakness is going to come. 401ks, mutual funds, likely culprit, right? Many mutual funds have faucets of money that fill their buckets up based on the 401 contributions that come along with the paycheck cycle. That's it. So there is this interesting cycle of human behavior that's going to be reflected into this end of month. And these Finnish researchers said, yeah, it's really going to be intense the last 3 days of the month into the first 3 days of the next month. I don't want you thinking it's a setup, but there's a tendency. There's a tendency, okay? So then that brings up a bigger tendency. This is a monthly cycle. And check that out. Again, institutions must make cash distributions regularly to pension beneficiaries, with the end of the month being a popular date for payments, right? So what happens during the last 8 days of the month, and most heavily during the last 3, institutions sell shares to generate cash, driving down prices. Okay, you think that makes sense. I'm probably one of those people that's doing it, paying myself every month. But then that brings up the bigger conversation that I want to dive into with you guys. It's a caution day. Be aware of this tendency for weakness and capitalize on that. Now, do you capitalize on it broadly? No. If there's a particular market that you've been waiting for a pullback in, it could be a broader average, it could be an individual sector, whatever it is, you can jump into something like Koifin.com and start to break down the individual sectors that are heavily weighted within the indices and say, which one's sort of pulling back hard, and is any one of them pulling back into the wave? Am I getting an opportunity in discretionary or industrials or tech? Where is it that I could take advantage of this phenomenon and see a continuation into May? But May brings up a whole other conversation, doesn't it? So if sell in May and go away is this other overarching concern that we have, and I'm going to take you on over to a site that I've used for a few years. It's called Seasonax. It's actually listed in my favorite things. Oprah's not the only one that has favorite things. I have favorite things too, and this is definitely one of them. And you'll see this on the list. And so Seasonax allows me to look at certain pockets of time. So let's say we're going to go ahead and look at the last couple days of April. So let's just put on the 30th, that's what today is, and we'll go to Labor Day, basically. So really Memorial Day to Labor Day is considered summer anymore, but let's just start at the end of April and look at what tends to happen in the S&P in that particular segment. All right, so there's a couple things I can do. I can actually detrend this, which is really important. Detrending is a cool feature where if you're looking at seasonal data, it's a very slippery slope to do this because a lot of people confuse seasonals with setups. I'm not doing that here. What I want to point out is there are some tendencies. Summer is not an easy thing. So what am I going to tell you in summer? You're really going to want to get a little bit more specific to relative outperformers. There are certain dips. If this summer is going to continue to be a bullish one, there are certain times that we should look for dips. Middle of May, beginning of June, end of June. And if there's a segment where it looks like we could see a nice rip higher, looks to be end of June to about the middle towards end of July. If I detrend it, it still works. Do you see that, gang? So that detrended look right there is a very interesting one. So sell in May and go away is actually probably seasonality-wise not true. Probably not true. It, for me, for us, means I might be better off being very nimble and fading range lows up to the range highs from the end of April to, you guessed it, about the middle to end of June. Then I'll look for a significant drop. And that is the one where I want to buy, right? And take advantage of what could be a really nice rally going into the end of the month. That's a seasonal. This means I've got to then make sure that my charts are jiving, syncing with that. This is the mistake a lot of people make when they look at seasonals and they don't then check the underlying price action. Jerome Powell on Wednesday pretty much told us stick with the long side of the market, and I'm not going to argue with him. Even with some of this end of month weakness, we haven't even touched the 13 exponential moving average. I don't think we've even touched the, let's see here. Take a peek. Not only have we not even touched the 13 EMA, which is a very shallow retracement, we haven't even touched the 10-day rolling. Well, when I say 10-day rolling, what I mean is I'll re-anchor this every 10 days. We haven't even touched that 10-day setting on the VWAP. This is not a big drop. In fact, the 13 exponential moving average has done a valiant job of keeping prices moving higher. So keep that in mind going forward. But if we start to see chop, we can go refer to that seasonal, look at some of the dates and say, okay, are we syncing with this yet or not? But I'm still in buy the dip mode, gang. There's no reason for me to abandon that whatsoever. All right, so I'm talking about the end of month sort of tendency with this summer tendency. So the question, again, we're asking is, do I really want to sell in May and go away? And the answer is no. We just need to be a little bit more specific about the timing. And we really want to think about if we see a sell-off into late June, is that going to be a terrific opportunity to buy, right? Overlaying that seasonal. So there's two different tendencies, end of month and summer. And the tendencies have to be sort of cross-checked, confirmed, verified with the current price. That's when you'll have something special.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency. It's one of the things that won me